Good afternoon and welcome back to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. We've been coming to you live from RatesEvolved, a conference brought to you by Viable Markets, the industry's only global interest rate conference. Joining me, we have Ann Battle. She's the Assistant General Counsel with the International Swaps and Derivatives Association, and we are going to focus on transitioning from LIBOR to SOFR. Is there a term for that?
SOFR.
SOFR. We love acronyms in this industry, apparently. So let's talk about that. Thank you for joining us, tackling the complexity of making this transition. I'm sure it's going to be a big focus over the next year or two.
Yeah, it will be a big focus over the next 1 to 3 years and potentially beyond. It's also been a focus of ISDA's really since 2016 and before. Even before the industry learned in mid-2017 that the future of LIBOR post-2021 was uncertain, there were efforts underway, particularly in the derivatives market, to identify rates such as SOFR that are more robust. And what that means is that they're based on actual transactions in an underlying market. So you hear a description of why LIBOR may not exist post-2021, and that is because panel banks won't be compelled to submit to LIBOR. So what does that even mean?
Right.
So LIBOR today, as we know it, is made up of submissions from a panel of banks. It is intended to reference interbank unsecured funding. However, that was a market that existed previously but does not exist in really any meaningful numbers today. And so instead of the panel banks being able to submit their transactions they actually entered into with other banks, they have to, in some cases, submit based on expert judgment. That is, what would they be able to borrow from if they had entered into those transactions. Panel banks are exposed to a lot of liability when they do so, and therefore we now know that a number of panel banks would like to stop submitting to LIBOR. However, if the panel banks don't submit, you have no rate. And so that is why the future of LIBOR is so uncertain. SOFR, on the other hand, is made up of repo transactions. So it's exclusively transaction-based. There are hundreds of billions of dollars of U.S. repos that the New York Fed compiles to produce SOFR on a daily basis. So it therefore does not require a panel of banks to potentially use expert judgment. The effort to move to these rates, as I mentioned, in the derivatives market has been going on for some time. It was just accelerated and expanded to other markets because initially there was a thought that rates like SOFR and LIBOR would coexist. So you would reduce some of the exposure on LIBOR, make it not so much of a monster, a behemoth, but it would still exist. So everything had to shift. It became much more time sensitive.
So will you run into that same risk with SOFR getting too big? It could potentially have some of the same issues as LIBOR, even though SOFR exists via transactions. You explained the structure of it, but do you have concerns at ISDA that it could get too big?
So the issue with LIBOR is not necessarily the volume of transactions based on it. It's the elephant on a peanut problem. It's the number of transactions based on it, even though so few transactions underlie it. So as long as SOFR is robust, and right now it's the most robust rate in the world, as long as there are so many repo transactions that underpin SOFR, it will be much less problematic if a great deal of transactions depend on it.
Will this impact market structure and liquidity with this switch?
Of course. I mean, one of the key steps towards transitioning to SOFR is establishing liquidity in that rate. So we need transactions based on SOFR. I mean, not to use another silly analogy, but it's a little bit of a chicken and egg, right? Like people, particularly end users and others, aren't going to switch to a rate if they don't even see the banks and bigger market participants trading it. So you need someone to lead.
It's always an issue with fixed income, like trade the product, but show me liquidity. But you can't get liquidity if you don't trade the product.
Exactly. So, and that's really the situation that we're in now. 2018 was promising. Really, there was no expectations for anything in 2018. And we saw bond issuances, we saw some derivatives. It's now possible to clear SOFR derivatives on the major interest rate CCPs. Is closely tracking transactions based on SOFR, as well as transactions that continue to be based on US dollar LIBOR. We're producing that on a quarterly basis, and we hope to see a trend throughout 2019. So 2018 was kind of about anything is good. And we saw something. But 2019 really needs to be about volume, getting the volume based on SOFR, getting the cash products so that there's something for the derivatives market to hedge, and then also increasing trading in the derivatives market so that a year from now we can more confidently go out to end users with an expectation that they'll use this rate.
All right, and to wrap up, how can firms best prepare for the transition?
I think right now, learning about SOFR, figuring out, can your systems trade SOFR? It is an inherently different rate. It doesn't have a forward-looking term structure. So figuring out if that's something your systems can handle, and if not, can your systems be changed to handle it? And then, from the risk mitigation standpoint, figuring out where you have exposure to LIBOR, and in particular, exposure to LIBOR that won't expire until after 2021, because those are the transactions where you may have to rely on fallbacks or amend or close out. And I think doing those two things in parallel, given the time pressure that we're under, is the best practice.
All right, and thank you so much for sharing your insight with us. And thank you for joining me throughout the day from RatesEvolved. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.